Welcome back. Well, we've been telling you it's a pretty good-looking screen across Asia. Cues are positive, and the market could be in for fresh all-time highs today. So that's the overall backdrop. Let's pull up the implied open again and see if it's still up about 50-odd points, because that's what the indication has been so far. Well, while those rates come up on the screen, let's introduce Ashish Jakhanwala, Chairman, MD and CEO at Samhi Hotels. Lots to discuss, lots to talk about. Ashish, great to have you. It's generally a good feeling, right? Markets also started moving higher. Then we're in the festive season. End of the year is coming. And this is a good season for you folks. It's the best time for the industry, right? The second half. So first, let's start by understanding that this whole, GST implementation, whatever changes that had to happen, especially I'm talking about your mid-scale hotels, not the upper ones. There any pricing tweaks, GST adjustments, I'm sure all that is done and out of the way now. So where does it leave you, and what's the outlook for the overall portfolio for H2?
Samhi, thank you for having me. So absolutely, H2 is always a great time, minus the Delhi pollution. So that's a dampener. But I think it's been a great run since Diwali. We've had an unprecedented November in terms of performance across hotels in India. So I expect that to continue till pretty much the end of the fiscal year. In terms of GST, you're absolutely right. I think while at a broader level, the reforms are fairly beneficial for boosting demand. But I think for the mid-scale, it was a dampener because of the removal of the input tax credit. So I think that is something that we would expect the government to reconsider, because it kind of negates the whole impact. But generally, H2 is very strong. Demand is strong across India from all sectors. So that's very heartening to see. But I think some of these irritants need to be removed now for the industry to continue to grow.
So Ashish, give us some sense on occupancies. How was the Diwali season, around that festive season, and what's your sense? Some ballpark range estimates will help as you're looking at Q3 and Q4. And you can break it down maybe in terms of the mid-scale and the upper scale hotels.
So, Surbhi, first of all, I have repeated many times over that it's not about the segment, it's about the cities, So if you're in a strong market, all segments outperform. And if you're in a slightly weaker market, then all segments will suffer. So I'll repeat it again, that the whole story is about location. It's not necessarily very segment specific. But coming back to your questions on capacity utilization and occupancy levels, we operate mostly a business hotel portfolio today. And we have seen occupancy levels remain in the mid-70s, largely because while Tuesdays, Wednesdays, Thursdays are sold out, we continue to see a slight dip on the weekends and also on extended holidays. But occupancy levels have been really strong. But what's been really, really good is because capacity utilization is its peak. And why do I say peak even though we're at 75? Because Tuesday, Wednesday, Thursdays are all sold out. And that has allowed the sector to reprice itself quite substantially this year over the last year, in the last 2 months. So overall, total revenue growth continues to be, as I said, extremely healthy in this year compared to the same time last year.
Right. Good points there. Ashish, morning. I was just looking at this is a more stock market question, and I know you'll say, well, we all look at the business. But Samhi's, you've deleveraged quite a bit, right? In a very, very fast time span. Finance costs are down quite a bit. Just in terms, if I look at Samhi and where the stock is trading compared to peers, trading at a deep discount. What is from an investor point of view, Ashish, you'll continue to deliver, execute, and you'll use the savings through low finance costs to expand some of this, to fund some of the expansion. What should we expect as we head into 2026? This 2025 has been about a sharp reduction in finance costs, deleveraging.
Prashant, so I would repeat expressing my inability or incompetence to decipher the stock markets and how they price. But I have always told some of the large investors that you decide the multiple, I'll decide the EBITDA. And I'm quite confident as to where the company's EBITDA would be in the next few years. And that pretty much determines the path to value creation for our shareholders.
So,
yeah.
So
what's the EBITDA target? Yeah, since you mentioned just you decide the EBITDA.
So I think Nigel, you're absolutely right. We used multiple events over the last 2 years. First, the public offering, then the partnership with GIC. The growth has been pretty substantial in our portfolio. Even the same store growth has remained at or above industry levels in the last several quarters. Going forward, we expect growth to continue to feed growth of EBITDA while our debt remains mostly constant. So net debt to EBITDA will continue to sharply fall over the next few years, even without any external capital interventions. So I think from a balance sheet perspective, we are sitting very tight, very, very healthy. In terms of growth, as you know, we've made some acquisitions over the last 2 years. We are well set to open the W in Hyderabad sometime next fiscal year. That will be an iconic hotel in the heart of Hyderabad. We have a Westin coming up in Bangalore in Whitefield, again, a great location. Recently we announced resolution of the issues at Navi Mumbai. That would be a single largest hotel, so 700 rooms at Navi Mumbai.
Ashish, that is, absolutely. My question was, so you said, right, I mean, a market decides the multiple, I'll decide the EBITDA. So give us some sense. I mean, how should we think about this? 26 is over, 27, 28, yeah.
So I think we'll continue to see EBITDA growth in the zip code of high teens to early 20s. That's what we expect the EBITDA growth to be. And that's really two components to that. One is same store. We expect to grow around 13-14% same store EBITDA growth. And then really is the contribution of the new assets of the inventory. So that's what I expect as a very reasonable conservative estimate of EBITDA growth in Samhi, even if we stop deploying any capital, which is really not a fair assumption. So I think we will continue to see high teens to early 20s EBITDA growth for the next several years.
High teens to 20%. Got that, Ashish. So as you scale up, what happens to the margin profile? Because in the past, you've mentioned that the upscale share in the portfolio will probably grow to about, I think you said 60%. And just revisit the timelines as well. You mentioned, for instance, W opening up and a couple of these marquee properties opening up. So what is the share of upscale right now as we speak? When does it scale up to 60%? And then I'm guessing it really pulls up the margin profile, right? So give us some sense on that. You're at about 35% margin now, EBITDA margin.
Yeah, so we are right now at about 42% share of upscale in our total revenues. We would see this go up to 65% in the next 4 years. Now, the whole transformation happens every single year. So every year you will see this 43% upscale proportion grow. Next year when we open the W. This year also we've added inventory to our upscale in Sheraton Hyderabad and Hyatt Regency Pune. Next year we open the W in Hyderabad. A year after that, we have some of the conversions happening to upscale. So I think you will see almost a linear progression from now till, let's say, 4 years from now, 42 to 60, 65%. And I think we'll stabilize around 65, 70% upscale. In terms of margin, we expect right now we are at about 37-38% reported EBITDA margins. We expect this to stabilize around 40-41%. We need to bear in mind that we do some assets on variable leases, which are 60 years, only revenue share and no minimum guarantees. And because of the Indian accounting standards, that rent also gets added to the operating expenses. So otherwise, net of that, we would have been about 42-43%. Otherwise, reported would be about 40-41%.
Mm-hmm. In terms of your association with GIC and that JV, I mean, is there any plan to transfer more assets to the JV? And how are you thinking of, just that partnership going ahead?
No, listen, I think it's a phenomenal partnership, great partners. We definitely intend growing the partnership. We're currently looking at some M&A opportunities outside. That's really our priority. In terms of whether we need to or we want to transfer some existing assets to the joint venture, there's no such current plans, but it's always an option available to both NGIC to discuss. But at this point, our focus is to really secure some external opportunities for growth.
All right, Ashish, we'll leave it there. Thanks very much for joining us. Good speaking with you, and thanks for being here.